let's say I come into the morning and I go, wow, I have a bias. Should I have this particular bias? Where should I start by saying, we always want to be present in the market as traders. Sometimes we get up and we go, this has got to turn around, or
Yeah.
this has got to move higher, or whatever it is. When we're staring something like that down, how how do we get ourselves to center first thing in the morning and we come to MenthorQ? Help us with that daily. Here's what you do first. Here's what I do first. Here's what my best traders using MenthorQ do. What would that be?
Yeah. So again, the typical trader that we serve would be like the futures trader. The futures trader is looking at the bias, but then is looking at building a roadmap, building the levels, right? So we showed you how you can kind of use the chart there. Then we have our zero DTE traders. So we saw a lot of increase in traders that want to mainly trade SPX. It's a very lucrative strategy, but it also comes with a lot of risk, right? So you could actually, we have users that are buying or buying calls or puts to get the direction, or that are selling to get the premium, right? So if you sell, you want the market to be calm, so you can pocket a premium, maybe stay in the trade 1 or 2 hours, and then just pocket the difference in premium by looking at theta decay. But then we also have like a swing trader. So as you mentioned, you read the news in the morning, you want to get an idea on the stock that are moving. So we have a lot of tools for that. But the first thing I would start from would be, if I go on under our vol model, is really looking at volatility. I think one of the mistakes that people make, they don't really understand how to read volatility. So what we have here is kind of like, we call it VRP, which stands for Volatility Risk Premium Asset Monitor. So these are the top assets: sector ETF, SPX, QQQ, VIX, etc. So immediately you can spot outliers, right? So you can see that gold is trading at the highest VRP it has been over the past 1 year. That means that the implied volatility of gold is really high right now. So as you mentioned before, volatility is like a rubber band. So like, it's going to eventually decrease over time. When that's going to happen, we don't know. But like, we know that this is an outlier. We also know that silver is an outlier, right? It's a big outlier. So we saw silver going all the way to all-time highs. It's crazy move.
52 and some change. It's bananas.
But we also see that SPX and QQQ are also quite big outliers. So they're actually trading at a very big premium. So you're actually getting a lot of value if you are selling up. So this quadrant is divided into kind of buying option buyers and selling option buyers, because the reason is that if you are buying options on SPX or gold, you're actually paying a very high premium. That doesn't mean that the premium is going to go down, but you actually have to account that. So if you're like an option trader, you need to understand that you're actually paying very expensive premium to buy calls or puts on gold, SPX, or QQQ, right? You're actually paying not a lot of premium if you're buying options on XLV or XLU. So this is kind of like give you an idea. Okay, like, is the market rich or cheap? Is volatility expensive or not? And this can tell you a lot about what the market expectation is. The second is I can go on to our screeners, and I always love to see the Q score screeners. The Q score was developed to give you very quick snapshot. So is this asset bullish or bearish, right? And I'm looking normally at the option score and the momentum score. But I don't just look at the high score or the low score. I like to see the data, right? So I want to see, for example, which are the assets that have seen like the biggest increase in option score. So for example, this is really interesting. Russell went from very bearish a couple of days ago to now kind of being almost bullish. This score goes from 0 to 5. So this could be an interesting small caps, overall market, Russell 2000. Then we have JetBlue, we have Lucid, Norwegian Cruise Line. But Russell is really interesting. So we can go here and look at Russell. And then now we see that although the overall indices like SPX and QQQ are in negative gamma, and are showing kind of like a negative positioning, the Russell is now showing positive bias coming from the option market, right? So very interesting. I can also see this is kind of like the VRP model for Russell. I can see basically if volatility currently is cheap or expensive. Here we are looking at the difference between implied volatility and historical volatility. So we are now kind of like in kind of a cheapish environment compared to a couple of days ago. So that means that if you're thinking of selling premium, you're actually not getting a lot of premium for what you're doing. So maybe it's probably more
Interesting.
to maybe buy option if you're thinking, and then you can bet on the direction. The next step is I want to see how the market is positioned around the full option chain. Again, why is that important? Because the option chain tells me the sentiment of the market. If next week the market is really bearish on an asset, is because maybe there is an expiration, there is an event, there's OPEX, maybe there's earnings or there's a Fed meeting, then that means that people are going to react to that information. So what I look here is I'm looking at overall throughout the option chain from now to the end of the year, are we seeing more positive and negative gamma, and has this increased or decreased? So we've seen like a big increase in positive gamma around October 17th. So this weekend, OPEX, of
Interesting.
course, very important. And then I want to look at my levels, my swing levels. Why are those important? Because the idea behind it is where are the areas where the price will not be. So you want to know, okay, what is my lower ceiling and what is my upper ceiling? And are we going to trade within this range, or are we going to break out of it? So what this is telling you is that on 84% of the days, we're talking about 120 days, the market stayed above this lower band.
Mm.
So again, it's not 100%. Nobody can give you 100%, but like
Mm-hmm.
telling me is like, okay, like so if I'm placing a bet, I can use that level as kind of like a confirmation or a confluence zone. To the upside, let's say that we move to the upside. Oh, the risk trigger has been hit. Well, there's only 47% chance that the price is gonna drop below that risk trigger. So that means that hey, maybe that risk trigger is actually a very important volatility level that I can use to my
Interesting. So, what
um,
I want to do, if we're staring down something like that, are you thinking iron condor? Are you thinking um, uh, a bullish put spread?
yeah.
Are you thinking long calls? Are you thinking something like, I don't know, what do they call that? A jade lizard, a synthetic long, or something like that?
Yeah, so if you come to our YouTube channel and on Friday, I'm gonna go over actually, it's another kind of episode of what we call trading like a quant, because essentially you think a quant is obviously this gigantic engine that has a lot of data, but in reality, the process is really simple. You're looking to create an edge by adding factors to your strategy, and we're gonna show you on Friday how you can start from really the simple analysis that I showed you to potentially add factors and create a better kind of return on your strategy. So the idea behind it is that you can start from one of these factors. So you could start from the Q score and say, okay, like the Q score is bullish. And on top of that, now let's overlay that with the volatility. So if I see a lot of high volatility, maybe I don't want to go long or short. Maybe I want to sell option, right? Because I'm going to get more premium for what's going on there.